Welcome back to Taxfinity, Decode Day number 69. Today we are looking at the Central Mine Planning and Design Institute Limited, or CMPDIL. They operate as a wholly owned subsidiary of the state-run energy giant Coal India Limited. Before an excavator touches the earth, someone has to map out deposits, evaluate the geology, and engineer the extraction process. CMPDIL provides that intelligence. They command one of the largest fleets of exploratory drills in India, backing up their planning with intense ground-level data collection. They provide the intellectual infrastructure that keeps India's largest energy producer functioning. To understand this specific initial public offering, we need to look at the structure. This IPO is entirely an offer for sale, or OFS. An OFS is a mechanism where existing promoters sell their shares to the public, rather than the company issuing new shares. This chart shows the exact transaction. The promoter, Coal India, is offloading 10.7 crore equity shares directly into the retail market. Because this is a 100% OFS, 0 rupees from this IPO will actually go into CMPDIL's corporate accounts for capital expenditure. Without an injection of fresh capital, there are no immediate plans to fund aggressive facility expansions or spin up new lines of business. Investors are buying rights to a mature cash flow engine rather than funding a new growth trajectory. Looking at the balance sheet, the financial metrics look completely detached from standard heavy industry norms. In fiscal 2025, revenue from operations jumped over 21%. CMPDIL boasts a 42% margin here, dwarfing competitors like Rights at 24% and EIL at 21%. Looking at their net income over time, they have maintained a 49.9% compound annual growth rate in profit after tax over the last 3 fiscal years. The compound annual growth rate, or CAGR, measures the mean annual growth rate of an investment over a specified period longer than 1 year. They have achieved this output while carrying absolutely zero debt on their books. Zero debt, massive cash generation, and profit margins north of 40% give this company the financial profile of an elite tech software firm rather than a government-owned mining consultant. An infrastructure firm achieving software-level margins requires an explanation. The mechanism is buried in risk factor number 1 of the red herring prospectus. CMPDIL operates on a captive client model. Because they serve their own parent company, their customer acquisition costs are practically zero. This chart visualizes their revenue concentration. A massive 95.8% of their entire revenue comes from just their top 10 clients, a group completely dominated by Coal India Limited and its subsidiaries. If the parent company decides to cut exploration budgets or bring these processes entirely in-house, CMPDIL loses its primary financial lifeline instantly. Their attempts to diversify into non-coal minerals and international consulting have so far yielded only a tiny fraction of their total income. Those elite margins are the byproduct of a closed-loop corporate monopoly, rather than the result of fiercely beating competitors in an open, competitive market. Risk Factor 27 outlines the macroeconomic threat of environmental, social, and governance mandates. ESG is a framework used to assess an organization's business practices and performance on various sustainability and ethical issues, driving the global transition toward renewable energy. Right now, CMPDIL's revenue model is entirely reliant on the continued extraction and burning of fossil fuels. They lack geographic diversification. Operating almost exclusively within India means any sudden domestic policy shift away from coal directly threatens their core business. As the massive deployment of new green energy infrastructure accelerates globally, the timeline for legacy coal extraction rapidly shortens. Thank you all for your love and support. Only 3% have subscribed. Please subscribe, like, and comment. Their short-term cash flows are heavily protected by their parent company, but the long-term terminal value of the stock is tied exclusively to the lifespan of India's reliance on coal. Weighing the captive client model against those massive margins brings us to the ultimate question: who is this IPO actually for? This graphic shows the clear division between the strengths and the risks. Growth-focused investors might step away from a 100% offer for sale and the severe lack of client diversification. However, dividend-seeking investors looking for a highly profitable, captive cash flow loop might find exactly what they want here. We will answer all subscriber questions in our upcoming Q&A video. Please be sure to subscribe to the Taxfinity channel. Disclaimer: this video is for educational and informational purposes only. The ultimate due diligence rests entirely with the individual investor. Do your research, understand the risks, and make your own decisions.